Market risk refer to the possibility of experiencing losses due to fluctuation in the market, such as change in equity price, foreign currency rate, commodity price, or other market conditions. Meanwhile, equity risk is a specific type of market risk that arises from change in the value of equity investment. This risk is particularly important in Islamic banking because Islamic bank may invest in Sharia compliant share and other equity-based investment. Therefore, change in the market value of this investment can directly affect to the financial performance of Islamic bank. The objective of the presentation is to explain the concept of market risk and equity risk in Islamic banking, identify the main factors that contribute to equity risk, and discuss its impact on Islamic financial institutions. It also aims to examine appropriate risk management strategies and provide relevant examples of how equity risk can be managed effectively. Equity risk is important in Islamic banking because effective management of this risk help protect the bank financial stability and profitability, support effectively investment portfolio management, and ensure that investment remain within Sharia compliant requirements. By managing equity risk properly, Islamic bank can reduce potential losses caused by unexpected change in equity prices while strengthening their ability to achieve their investment objective.
And I will continue with the definition and causes of equity risk. First, equity risk refers to the risk of financial loss caused by changes in the market value or price of an equity investment, which is in Islamic banking. Equity risk arise from equity-based investments such as musyarakah and mudarabah, where the Islamic financial institution is exposed to the performance of the underlying business. In simple terms, when the value of performance of an equity investment decreases, the institution may experience a financial loss. There are several causes of equity risk. First, changes in market prices, where fluctuation in equity prices can reduce the value of investment. Second, poor business performance such as low profitability or weak financial performance can reduce the value and expected returns. Third, economic conditions including economic downturns and inflation can negatively affect equity prices and investor confidence. Other causes include market volatility, investment concentration, and business or management risks. In Islamic banking, these risks are particularly relevant to musyarakah and mudarabah because the institution is exposed to the performance and value of the underlying business.
Impact to Islamic bank. First, capital loss from musyarakah and mudarabah financing. When a business or project financed through musyarakah or mudarabah contract incurs loss, the bank also bears that loss since it based on equity partnership, not fixed lending. This means the bank's exposure is directly tied to how well the finance business performs. Second, unstable income. Unlike debt-based financing which give fixed return from equity contract depend on the actual performance of the business, so they fluctuate and are unpredictable. As a result, the bank cannot rely on a consistent income stream the way conventional leaders can. Third, pressure on capital adequacy ratio (CAR). Large loss in equity investment reduce the bank capital, which can affect the CAR, the ratio showing the bank's financial strength to absorb risk. When CAR drops too low, the bank may be forced to raise additional capital or limit its financing activities. Fourth, damage reputation and market confidence. If a bank frequently suffers losses from equity financing, customer and investor may start doubting the bank's credibility and stability. This loss of confidence can make it harder for the bank to attract new deposit or investment funds in the future. Fifth, higher provisioning needed. the bank need to set aside more fund and provision to cover potential future equity losses, which reduce capital available for other activities. Over time, this tie up resource that could otherwise be used to growth of new financing opportunities. Next, impact to investor or customers. First, uncertain investment return. Customers who invest in equity-based product like Mudharabah investment account are not guaranteed fixed return. It depends entirely on investment performance. This means customers must be prepared to accept both potential gains and potential losses. Second, bear losses to profit and loss sharing. Under the PLX concept, customers share losses together with the bank, completely different from the conventional system where customer deposits are guaranteed by the bank. This share risk structure is a core feature of Islamic finance, but also means customers carry more responsibility for understanding the risk involved. Third, risk of losing confidence and withdrawing funds. When returns are uncertain or frequently negative, customers may lose confidence and choose to withdraw their funds. This can create liquidity pressure for the bank if withdrawals happen on a large scale. Fourth, lower trust in equity-based investment account. The uncertainty can in the long run reduce customer interest in investing in Islamic equity investment product. Consequently, banks may find it harder to grow their equity-based financing portfolio. Fifth, may shift to safer, fixed return product. Many customers may prefer products that offer fixed return and lower risk compared to equity-based product. This shift in customer preference can limit the bank's ability to expand the equity-based offerings. Next, impact to financial performance. First, decline in ROA and ROE. Losses in the equity portfolio directly lower return on asset and return on equity, two key indicators of a bank profitability. A consistent decline in this ratio can also affect how investors and analysts rate the bank overall performance. Second, increase in non-performing financing (NPF). If businesses financed through equity contract fail to perform well, the bank non-performing financing (NPF) rate will increase. A rising NPF signal weaker asset quality and may require the bank to increase its loss provision further. Third, potential systemic risk. If many Islamic banks experience equity losses simultaneously, such as during an economic downturn, it can threaten the overall stability of the Islamic financial system. This is why regulators closely monitor equity risk exposure across the banking sector. Fourth, volatility in overall bank profitability. Depends on variable equity return make the bank overall profitability more inconsistent from year to year. This volatility can make it harder for the bank to plan long-term strategies or forecast future earnings. Last but not least, weakens competitiveness. Unstable financial performance can weaken the bank competitiveness compared to other financial institutions, whether Islamic or conventional. In the long run, this may affect the bank's ability to attract new customers and retain market share.
The first strategy that can be used to manage equity risk is diversification. Diversification refers to the practice of spreading investments across different companies, sectors, or industries instead of concentrating too much investment in one particular company or sector. The main purpose of this strategy is to reduce the impact of losses from a single investment on the overall investment portfolio. Diversifications help to reduce concentration, risk, and dependence on a single company or sector. It also minimizes the impact of losses for individual investments and help create a more balanced investment portfolio. For example, an Islamic bank may invest in different Sharia-compliant sectors such as technology, healthcare, consumer products, and energy. If the performance of the technology sector declines, the bank may still have investments in other sectors that perform better. Therefore, the losses from one investment may be partly offset by the performance of other investments. In the context of Islamic banking, diversification should be applied across Sharia-compliant equities, while ensuring that all investments comply with Sharia requirements. This slide shows how diversification works in managing equity risk. Without diversification, investments may be concentrated in one company or sector. If that investment performs poorly, it can have a significant impact on the overall portfolio and result in higher equity risk. In contrast, with the diversification, investments are spread across different companies and sectors. If one investment performs poorly, other investments may perform better. Therefore, the impact of an individual loss on the overall portfolio can be reduced. However, diversification does not completely eliminate equity risk, especially when the overall market experiences a major decline. Therefore, Islamic banks should regularly monitor their portfolios and ensure that their investments remain Sharia compliant.
Moving on to our second risk management strategy for liquidity risk, maintaining a high-quality liquid asset (HQLA) buffer. In simple terms, this strategy requires an Islamic bank to hold a reserve of top-tier Sharia-compliant liquid asset, such as sovereign sukuk or central bank deposit, that can be instantly converted into cash during financial distress. The main advantages are: first, it acts as immediate safety net during liquidity crunches. Second, it ensures we meet regulatory mandates like the Liquidity Coverage Ratio (LCR). And third, it boosts market confidence among depositors and investors. However, there are trade-offs. The primary drawback is lower profitability. HQLA asset yield lower returns, creating an opportunity cost compared to higher yield financings. Furthermore, in Islamic finance, the pool of high-quality liquid Sharia-compliant instrument is limited, making asset sourcing challenging.
Now, I will discuss the critical reflection on the strategy used to manage equity risk. First, in terms of effectiveness, diversification can help reduce the impact of losses from a particular company or sector. Sharia screening is also important because it ensures that equity investment remain consistent with Islamic principles. In addition, continuous monitoring allows Islamic financial institutions to identify changes in market conditions and respond more quickly. However, there are several challenges. Equity prices can change rapidly because of economic conditions, investor sentiment, and unexpected events. Islamic financial institutions also need continuous Sharia monitoring to make sure their investment remain compliant. Furthermore, diversification cannot completely protect an institution when the overall market experiences a major decline. There are also some weaknesses. No risk management strategy can completely eliminate equity risk. Regular monitoring and Sharia screening may also require additional resources, technology, and skilled personnel. In addition, strategies that work under normal market conditions may become less effective during sudden market shocks. Therefore, we recommend several improvements. Islamic financial institutions should strengthen real-time monitoring of equity portfolio, conduct regular Sharia and risk assessment, and improve diversification across different sectors and markets. They should also use stress testing to evaluate how their portfolio would perform under extreme market conditions. Overall, the strategies are useful in reducing and controlling equity risk, but they need to be continuously reviewed and improved because equity markets are constantly changing.
Equity risk in Islamic banking through the real-life case of Kuwait Finance House or KFH, equity risk happens when an Islamic bank faces direct potential losses from market volatility in its equity positions or profit-sharing contracts like Musyarakah and Mudarabah. During the 1980s Sok Almanak stock market crash, KFH experienced severe financial stress due to over-concentration in volatile equity and real estate holdings. So, how did this risk actually hit
What role does the
KFH?
Sharia
First,
advisory
as
council
stock
play in
prices
managing equity
collapsed, the
risk?
bank's equity portfolio value plummeted. Under profit and loss sharing rules, KFH had to absorb these losses as the capital provider. On top of that, information asymmetry created moral hazard risk with venture managers. The end result was very heavy capital erosion, which directly depleted Tier 1 capital and strained the bank's liquidity position. To recover and manage equity risk long-term, several strategies were implemented. KFH established strict portfolio concentration caps and diversified across sectors. They shifted toward after musyarakah with direct board oversight rather than passive funding. Financial buffers like profit equalization and investment risk reserve were set up to cushion future losses, complemented by modern AI risk engine and AA0 IFI mark-to-market valuation standard. To conclude, while profit and loss sharing is the Sharia ideal, it carries heavy risk weighting under IFSB and Basel rules. The key takeaway from KFH experience is that equity risk cannot be managed passively. It demands active governance, realistic asset valuation, robust reserve buffers, and digital risk analytics to ensure financial stability during market downturns.
Thank you to my group members for presenting the key aspects of equity risk before this. In conclusion, we can see that equity risk is one of the major challenges unique to Islamic financial institutions due to the nature of profit and loss sharing contracts that underpin products such as musyarakah and mudarabah. Unlike conventional banks, which focus primarily on credit and interest rate risks, Islamic banks are also exposed to fluctuations in the actual investment performance of the clients or entrepreneurs they finance. From our discussion, it is clear that effective management of equity risks requires not only technical strategies such as portfolio diversification and profit equalization reserve, but also a robust governance and strict Sharia compliance. To this end, our group proposed several improvement measures. First, strengthening the risk assessment process prior to any equity investment. Second, improving continuous risk monitoring systems. Third, enhancing staff training related to equity risks. Fourth, strengthening collaboration with the Sharia Advisory Council. And fifth, leveraging technologies such as data analytics for more proactive risk forecasting. By implementing these recommendations, Islamic financial institutions can manage equity risk more effectively while remaining compliant with Sharia principles and safeguarding the interests of all stakeholders. That concludes our group presentation. We now open the floor for a question and answer session.